Hello everybody, my name is Mark. Welcome to another video in my video series, The Profitable Investor. The Profitable Investor is a video series I created to help you become a better investor. And in this video, I'm going to talk about the two biggest myths in all the world of investing. I thought about using stronger language or words like the two biggest lies or the two dumbest things that people believe about their money, etc. But I'll go with the word myth. I'll make the assumption that there's a lot of people out there that are well-meaning people that have been duped. They have been listening for years and years to all of the financial advisors and the money managers telling them these things, and it's total rubbish. And so I'll use the word myth. The two biggest myths in all the world in all the world of investing. So without further ado, let's get started and let's talk about the first one, dollar cost averaging. I've heard this idea explained a couple different ways. The first way is you have some money, you take a third of your money and you buy some stock, and then you wait till that stock moves up or down 10%, and then you buy some more shares, another third of your money, and then again you wait till the stock moves up or down 10%, and then you buy some more shares. And the myth is that somehow this is going to lower your overall risk of losing money in the market. But let's look at some real live examples. Let's start with this one, BlackBerry. If you would have bought this stock, let's say about 10 years ago, this is a 10-year chart of BlackBerry, and back in 2008 and 2009, you can see it was going at around $125 a share. And then the bottom fell out and it never recovered. And now, as of today, 2017, it is still trading at about a whopping $6 a share. So if you would have bought a third of your money into this stock, you would be hurting big time. And dollar cost averaging wouldn't have helped. You would be down a lot of money. So now Chipotle, okay, now if you would have bought this stock back a few years ago in 2013, that'd be okay, right? But let's say you bought it just a year or two ago. You can see it was at one time over $700 a share. Now it's down to about $400 a share. So if you would have dollar cost averaged on this, you would be down, okay? So this is a funny little cartoon that kind of explains why I dislike dollar cost averaging. When you dollar cost average, you're buying more shares of a stock that's going down, and when it's going higher, you're buying fewer shares, you know? So as you can see, Hank said it's brilliant, right? Funny little cartoon. Now, the second way I've heard dollar cost averaging explained is by automatic deductions. You have a job and you take it out of your paycheck automatically into your Roth IRA or 401k. And I've heard none other than Susie Orman, financial guru extraordinaire, endorse this wonderful idea. And here she says, investing the same dollar amount every month of the year in the same stock or mutual fund, dollar cost averaging, is the single best way to minimize your risk of buying shares at the wrong time. Now, I would like to highlight this part of her words. Minimize your risk of buying shares at the wrong time. So here, she's implying that you can actually time the market, and that somehow by dollar cost averaging, you are minimize your risk of buying it at the wrong time. But what reputable investor would tell you that you can time the market? Here's a quote that I found on the internet by this guy. I've never heard of him. His name is Nick Murray. Timing the market is a fool's game, whereas time in the market is your greatest natural advantage. And that's true. I did some videos on compound interest, and the most powerful force in the universe is time. It is an exponential multiplier. Timing the market is a fool's game. Now, the funny thing about this quote is that this guy Nick Murray, like I said, I've never heard of him, but this guy Nick Murray is using this quote to support the idea of dollar cost averaging. He is actually in favor of dollar cost averaging. So going back to the previous screen here, dollar cost averaging is the best way to minimize your risk of buying shares at the wrong time. That sounds like timing the market to me. So it's funny how all these people contradict themselves, these financial gurus that can't seem to make sense of their own logic and their own ideas. So the bottom line, ladies and gentlemen, dollar cost averaging will not prevent you from losing money. You saw BlackBerry and Chipotle, how much you would be down if you would have dollar cost average into those losers. If you dollar cost average during a recession or a major sell-off, you're simply buying more shares of a stock that is going down. Dollar cost averaging can be a good investment strategy during a bull market, but it does not lower your risk of losing money. That's the bottom line. Real risk management strategies are methods and techniques that actually prevent you from losing money. Meaning, if the market tanks, your portfolio or your account does not tank with it. Now, let's jump in, let's move on and go into myth number 2. Diversification, otherwise known as a mutual fund. Now, let's start off with a bang, and here you can see Warren Buffett giving a nice quote, "Wide diversification is required when investors do not understand what they are doing." And then this one, diversification is protection against ignorance. It makes little sense if you know what you're doing. So what's he saying? Most people who diversify, Warren Buffett is well known for all the hours he puts in studying companies, looking for good values. But if you don't know what you're doing, Warren Buffett's saying you might as well just diversify, which is like getting a dartboard and throwing darts and saying, well, this dart hit a winner and this dart, this one missed and this one hit and this one missed. And it is protection against your own ignorance, but it makes little sense if you know what you're doing. The myth is spreading your risk among these multiple investments lowers your overall risk of losing money. Now keep in mind that if you diversify, you're also diversifying your profits. And so you'll lose out on profits just as much as you'll lose out on the losses. So what good is that? And I think that's part of what Warren Buffett was saying in the other quote. Now, here is a nice little statistic that I found on Investopedia.com. And here, if you read this quote, you can see, and this quote was written in 2015. So this would have been a couple years ago. And the 5-year period of mutual funds, 80% of the time, they did worse than the S&P. And over a 10-year period of time, also 79.59. So 80% of the time, mutual funds underperformed. And these are large cap mutual funds. And then he goes on to say these type of figures are similar in other asset classes like small caps and foreign stocks. So if you would have bought, let's say, call options or futures on the SPY, the S&P, this SPY, and I pulled this chart off of my account. This is a 20-year chart. If you would have just bought futures or call options, you would have an 80% chance of performing better than whatever mutual fund you have your money in. Now, what kind of people like to tell you to diversify? Now, if you said certified financial planners or licensed financial advisors, you would be correct. Okay? A financial advisor, the technical name is a registered investment advisor. And a registered investment advisor is a person or firm that for compensation, ding, 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 is engaged in the act of providing advice, making recommendations, etc., etc. So the bottom line, guys, is financial planners get paid to sell you their financial products, aka mutual funds. Financial planners will not tell you diversification is a bad idea during a recession. Financial planners rely on your money to make their living. If they tell you the market's going down and you pull your money out, that cuts into their paycheck. They do not have your best interest at heart. Most financial planners are not financial planners. They are salesmen. You have to remember that. If the market goes down, they'll say, oh, don't worry, you're dollar cost averaging. Just keep saving money into your account every month. The market will come back up. And there you have it, ladies and gentlemen. This is the indoctrination that is going on a wide scale level. Okay? It's rubbish. And all the while that you are diversifying and dollar cost averaging, the market tanks and tanks and your money goes down, down, down to nowhere land. The bottom line, again, diversification will not prevent you from losing money. If you diversify during a bear market or a major sell-off, you will simply lose money in multiple stocks. Diversification can be a good investment strategy during a bull market, but it does not lower your risk of losing money. Real risk management strategies are methods and techniques that actually prevent you from losing money. In other words, if the market tanks, your money doesn't tank with it. So that's it, ladies and gentlemen. Those are the two biggest myths in all the world of investing. If I think of the people that I've talked to in my life, I've probably talked to over 100 people. If I think of people I went to school with, family, friends, people I go to church with, the gym, and just random people, I probably talked to 100 people, over 100 people. And that's the reason I say these are the two biggest myths, because the vast majority of them believe these things. They believe that if you are dollar cost averaging, that you're doing good, that you're a good investor, right? But listen to guys like Warren Buffett. Okay, it is protection against your ignorance. It is much better if you just learn how to invest. Actually learn what investing really is and learn how to make good investment decisions. So thank you for watching this video, and stay tuned. I have more videos to come. I will be doing some videos on real risk management. So until then, I will see you in the next video.